What if your life savings were safe one day and completely inaccessible the next? Not because you spent it, but because the system holding it stopped working? In this video, we look at what happened during the 1929 banking crisis and what it teaches about how banks work. This is not fear-based content. It is a simple explanation of financial systems, historical events, and how people think about safety, access, and risk in modern banking. Why you should keep watching. By the end of this video, you'll understand how banks actually operate behind the scenes, why some financial systems become fragile under pressure, and what history shows about protecting money during uncertain times. The goal is clarity, not fear, just a better understanding of how the system works. A story from 1930. Imagine it is October 1930. You are a farmer in rural America. You worked all year. You sold your harvest. You deposited your savings into a local bank. That money is not extra. It is your survival fund. Your next planting season depends on it. One morning, you go to withdraw a small amount for daily needs. But something is wrong. There is a line outside the bank. People are nervous. The doors are closed. A handwritten note says the bank is temporarily shut. You knock. No response. Inside, your money is still there, but you cannot access it. This is what many Americans experienced during the early 1930s banking crisis. What happened in 1929 to 1933? The 1929 stock market crash is often remembered as a financial disaster. But the deeper problem was not just stocks, it was the banking system. At that time, thousands of small and regional banks operated across the United States. Many of them did not have strong protections or backup systems. When people began losing confidence, they rushed to withdraw their money at the same time. This created what is called a bank run. And banks do not keep all deposits as cash. They lend most of it out. So when too many people asked for money at once, banks simply could not return it. Between 1930 and 1933, thousands of banks closed. Millions of people temporarily or permanently lost access to their savings. How banks actually work. To understand why this happened, we need to understand how banking works. When you deposit money in a bank, the bank does not store it like a locked box. Instead, it uses most of it for lending and investments. A small portion is kept as reserves. This system is called fractional reserve banking. It works like this. You deposit money. The bank lends most of it out. Borrowers spend it elsewhere. That money returns to other banks. The cycle repeats. This system helps the economy grow by increasing available credit. But it also creates a timing problem. Your money is available on demand, but the bank's assets are locked in loans. That mismatch is where risk comes from. The fragility of confidence. The entire banking system depends on trust. If people believe their money is safe, they leave it in the bank. If they lose confidence, they all try to withdraw at once. But banks cannot physically return everyone's money instantly. This is what happened in the early 1930s. It was not just one bank failing. It was a chain reaction. One failure reduced confidence in the next bank. That created more withdrawals, and more failures followed. This is why banking systems are sometimes described as fragile during panic situations. The government response. After the crisis, governments introduced protections to rebuild trust. One of the most important changes was deposit insurance. In the United States, this is handled by the FDIC. The idea is simple. If a bank fails, depositors are protected up to a certain limit. This reduces panic because people know at least part of their money is safe. This system has worked well in many smaller bank failures. But it is important to understand what it does and what it does not do. It does not remove risk from the system. It helps manage confidence during stress. What we learned from later crises. Banking stress did not end in 1929. We saw similar issues in later events, the 2008 financial crisis, the 2013 Cyprus banking crisis, banking stress episodes in 2023. In some cases, governments protected depositors fully. In others, access to money was temporarily restricted. In rare cases, large deposits were partially converted or reduced during restructuring processes. These events show that, while systems evolve, financial stress still follows similar patterns: loss of confidence, liquidity pressure, and emergency intervention. Where do people store money during uncertainty? This is where things become practical. People and institutions respond to uncertainty in different ways. Some rely on bank deposits because they are convenient and insured. Some diversify into government-backed securities. Some hold physical cash for liquidity. Others use assets like real estate or commodities. Each option has trade-offs. Cash is liquid but can lose value over time. Government securities are stable but depend on access systems. Physical assets are less liquid but more independent. Bank deposits are convenient but depend on institutional stability. There's no single perfect option. Each system works differently depending on economic conditions. The key idea: access versus ownership. One of the most important ideas in this topic is the difference between access and ownership. When money's in a bank, you usually have full access to it in normal conditions. You can withdraw it, transfer it, or use it for payments anytime you need. This creates a strong feeling that the money is completely yours, because day-to-day life works exactly that way. However, legally, the situation is a bit different. When you deposit money into a bank, the bank becomes the legal holder of those funds. In return, the bank gives you a promise, a contractual obligation, that it will return your money whenever you request it, under the agreed conditions. Most of the time, this system works very smoothly. Payments are fast, transfers are reliable, and access feels instant. Because of this consistency, people rarely think about what is happening behind the scenes. But during financial stress, system-wide pressure, or banking disruptions, that access can sometimes become temporarily limited. This does not usually mean the money is gone, but it can mean delays, restrictions, or temporary freezes while the system stabilizes. Understanding this distinction between access and ownership helps explain why banking systems can behave differently under pressure, even though they feel stable in everyday use. Balance: strength and fragility together. Modern banking systems are not weak. In fact, they are one of the most powerful financial systems ever created. They support global trade, business growth, and everyday transactions. But they are also built on shared confidence. That makes them efficient in normal times and sensitive during extreme stress. Both things can be true at the same time. What history really teaches: the lesson from 1929 is not that banks are unsafe. It is that systems based on trust require stability to function properly. When confidence breaks, even strong systems can experience stress. But history also shows that systems adapt. New protections, regulations, and tools were created after past crises to reduce risks and restore trust. So the system today is not the same as 1929, but it still follows similar economic principles. Final thoughts. So when we ask, where should cash be stored when banks fail? The real answer is not simple. It depends on time, system design, and economic conditions. What history shows is that no system is completely risk-free, but understanding how systems work helps people make more informed decisions. And that is the real value of studying events like 1929. Not fear, but awareness. If you found this explanation useful, you may also enjoy our next video, where we break down how modern banking systems actually create money. And if you like simple explanations of complex topics, consider liking the video and subscribing for more. See you in the next one.